Hello, everyone, and welcome back to Synaptic Investing. Hope you're having a fantastic week and are ready for another deep dive.
Absolutely. Great to be diving in again.
Today, we're breaking down one of the most iconic yet recently really troubled industrial giants, the Boeing company.
Boeing, yeah. For decades, they were just synonymous with American ingenuity, engineering prowess, the marvel of flight itself, right?
Totally. But, well, the headlines lately, they paint a very different picture. Turbulence, safety concerns, deep financial distress. It's a worrying story.
It really is. And our mission today, for you listening, is to get past those headlines. We're going to, really dissect what's going on inside Boeing.
Right. To figure out if this, once great company can still be called a wonderful company, is it suitable for a long-term, multi-decade investment? That's the core question.
Precisely. Has a management philosophy, maybe spanning decades, fatally wounded this titan? Or, is it maybe just a classic turnaround story waiting to happen? That's what we're here to find out.
That's a massive question. And before we get into the details, just a quick note for everyone watching.
Sure.
For those who want to act on these investing ideas, having a professional grade platform is key. We use Interactive Brokers, and we've partnered with them to get our viewers a stock bonus when they sign up.
So they get a bonus and support the channel at the same time. That link is in the description, right?
That's right. And of course, if you find value in this kind of in-depth discussion, the best way to let us know and, to get the next one is to subscribe and like the video. It truly helps the channel. And if you have any questions regarding the company, please manifest yourself in the comments section.
Perfect. Now let's get into it. Pillar number 1, the business model and its supposed competitive fortress.
Okay, let's start there. The business itself. Because here's the paradox that really gets me. Boeing operates in this incredibly powerful duopoly, right? They basically share the global commercial aircraft market with just Airbus.
Mm-hmm. Just one other player, essentially.
And they benefit from these huge long-term tailwinds. Global air travel is growing, defense spending is up, demand for their products should be soaring for decades.
Absolutely undeniable trends, yeah.
So how can a business with those advantages be in such deep trouble financially? Right now it's unprofitable, it's burning through cash like crazy, it's got heavy debt, and the returns on invested capital are, profoundly negative.
It just doesn't seem to add up, does it? How can such a privileged position lead to such financial distress? That's the core puzzle we need to unpack.
Exactly. So let's lay the groundwork. Boeing's business, simple concept, flawed execution seems to be the theme.
Right. At its heart, it's pretty straightforward. They make things that fly and then they service them. 3 main parts or segments.
Okay, what are they?
First, you've got commercial airplanes, BCA. That's the big one, historically. Then there's defense, space and security, which is BDS. And finally, global services, BGS.
BCA, BDS, BGS. Got it. So how do these actually make money? Or not make money, as the case may be?
Well, that's where the picture gets really clear, really fast. BCA, commercial airplanes, that was the heart of Boeing. The 737, 777, 787, selling those jets to airlines worldwide. That was the main engine for revenue and, importantly, profit for decades.
Was. Key word there. Because now
it's the epicenter of the crisis, no question. Look at the numbers. Fiscal year 2023, BCA pulls in, about $33.9 billion in revenue?
Mm-hmm.
Sounds big. But an operating loss of $1.6 billion.
But $1.5 billion loss on the commercial side. That's already a huge red flag from its history.
Huge swing. But wait, it gets worse. Fiscal year 2024, revenue collapses by a third, down to $22.9 billion in the operating loss. It balloons to nearly $8 billion. Negative $8 billion.
Wow, $8 billion just from commercial airplane manufacturing.
Yeah, think about that. A core segment bleeding that profusely. An $8 billion operating loss isn't just like a bad quarter. It suggests a fundamental breakdown. They literally can't build and deliver planes profitably at scale right now.
It means every plane costs more to make than they sell it for before you even count corporate stuff.
Basically, yes.
Yeah.
Imagine the operational chaos behind that number.
Yeah.
It's staggering.
Okay, so BCA is in deep trouble. What about the second segment? BDS, defense, space, and security. That sounds stable, right? U.S. government contracts.
You'd think so. It's their diversification, military aircraft, satellites, weapons. The U.S. government is the main customer. Should be predictable. But, they've really struggled with profitability there too, especially on these fixed price development programs, where they agree on a price up front, and if costs overrun, Boeing eats it.
Okay. So if things go wrong, it hits their bottom line hard.
Exactly. And things often go wrong on complex defense projects.
Yeah.
So FY23 BDS revenue was $24.9 billion. Again, sounds good, but an operating loss of $1.8 billion.
Another loss.
And FY24, even worse. The loss deepens to $5.4 billion on revenue of $23.9 billion. So you've got another major segment actively losing billions. It highlights the risks when execution isn't perfect on those fixed price deals.
So BCA losing billions, BDS losing billions. This brings us to the third one, global services, BGS. Is there any good news here?
Actually, yes. BGS looks like it belongs to a different company entirely. It's been Boeing's financial bedrock. It's the most consistent, most profitable part.
What do they do exactly?
It's all the aftermarket stuff. Spare parts, maintenance, engineering support, data analytics for both the commercial planes and the defense systems they've sold. High margin, recurring revenue.
Ah, the razor and blades model, kind of. Sell the plane, then sell the support for decades.
Precisely. And the performance shows it. FY23 BGS. $19.1 billion in revenue and a $3.3 billion operating profit.
Profit, finally.
And it continued into FY24. Revenue grew to $20 billion, profit up to $3.6 billion. It's a stark contrast. These aftermarket services are just inherently profitable if run well. Proprietary parts, captive customers. Airlines need this stuff to keep flying.
Okay, so this contrast is really telling, isn't it? BGS doing great, making billions, BCA and BDS bleeding billions. What does that mean about Boeing's core problems? It's not like everyone there is incompetent, right?
That's the crucial insight. The success of BGS proves it's not enterprise-wide incompetence. If it were, BGS would be struggling too.
So the problem is specific.
Highly specific. It points to a deep systemic breakdown concentrated in the core manufacturing and engineering culture, primarily within BCA, but also affecting BDS. The fact that BGS runs well actually makes the failure of BCA even more, well, damning. It shows they can operate effectively. It's a targeted failure, a particular kind of brokenness related to building the core product.
Got it. Execution flaws in the core manufacturing bits. But let's pull back again. Despite these execution issues, the fundamental demand for what Boeing makes seems incredibly solid, right? People want to fly, governments need defense.
Absolutely. The foundations are incredibly strong. The desire to travel, the need for defense, these aren't going away. The structural trends in aviation alone are just, well, massive. Industry forecasts, including Boeing's own, predict global passenger traffic growing somewhere between 3.4% and 4.2% annually for the next 2 decades. That outpaces global GDP growth. It means passenger traffic could more than double.
Double? Wow. And that means more planes needed.
Well, a lot more planes. We're talking estimates of nearly 44,000 new commercial aircraft needed by 2044.
44,000? That's almost double the entire current global fleet, isn't it?
Pretty much. It's a staggering number. And it's driven by the expanding global middle class, especially in Asia, the Middle East. People taking their first flights. It's a huge multi-decade tailwind.
And people want to travel, right? Post-pandemic, travel spending bounced back fast.
Immediately, it's prioritized. That's a powerful secular trend supporting new plane sales for BCA and the aftermarket support for BGS that keeps them flying.
And on the defense side, geopolitics seems, well, tense.
To say the least. Global defense spending hit almost $2.5 trillion in 2024. The U.S. budget alone, Boeing's main defense customer, is projected to top $1.1 trillion by 2034.
So BDS has a solid demand floor, too.
A very stable, long-term demand floor. So yes, the business model is easy to understand. The demand is incredibly strong and enduring. Which brings us back to that critical question.
Can Boeing actually deliver on this demand safely and profitably?
That's the billion-dollar question. Or maybe, given the losses, the multi-billion-dollar question.
Okay, let's talk about the moat, the competitive fortress. Traditionally, Boeing's was formidable, that duopoly with Airbus.
Incredible moat. Sharing the global market for large commercial jets. The barriers to entry are just immense.
That makes them so high.
Several things reinforce each other. First, intangible assets. Decades of proprietary knowledge, patents, complex systems, integration expertise. You can't just replicate that deep know-how.
Right. Building a modern jetliner isn't like building a website.
Not even close. Then, regulatory barriers. Getting a new plane certified by the FAA, EASA, it's incredibly rigorous, takes years, costs billions. It basically stops anyone new from realistically entering the market for large jets.
Okay, knowledge and regulation. What else?
High switching costs for the customers, the airlines. Once an airline commits to, say, a Boeing 737 fleet, they invest billions in pilot simulators, maintenance tools, spare parts, training, all specific to Boeing.
So switching to Airbus isn't just buying new planes, it's redoing their entire operation.
Exactly. Prohibitively expensive. They make fleet decisions for decades. This locks them in.
And this moat historically gave Boeing, what? Pricing power? Visibility?
Immense pricing power and extraordinary revenue visibility. The best example is the backlog. Even now, amidst crisis, the total company backlog was $520 billion at the end of 2023.
Yeah.
That included over 5,600 commercial planes.
520 billion, that's a huge number. A theoretical buffer, you said.
Theoretically, yes, it should cushion them, allow long-term planning. It's a luxury few companies have. But, and this is the crucial point, a fortress is only as strong as the people defending it.
And you're saying the defenders are faltering.
I'm saying the moat isn't being breached from the outside. It's being eroded from within by, frankly, shocking degrees of self-inflicted damage. The trajectory of this moat is unequivocally narrowing.
Narrowing? That's a strong statement for a duopoly moat. How can we see this erosion happening? What's the evidence?
Well, look at market share first. Airbus has decisively taken the lead. Over the last decade, say 2015 to 2024, Airbus booked nearly 9,000 orders. Boeing, only around 5,000.
So Airbus is winning the order race significantly.
Significantly. Airbus now holds roughly 60% market share to Boeing's 40%. That's not just a blip. It reflects a real shift driven by Boeing's problems. And it's not just orders, it's actual deliveries.
Right, deliveries are where the cash comes in. How's that gap look?
Stark. In the first half of 2024, for example, Airbus delivered 447 planes. Boeing managed only 175. That's production paralysis. They're effectively giving market share away because they can't build the planes.
Leaving billions on the table. Voluntarily ceding the market to their only rival.
Precisely. And then the elephant in the room, the reputational collapse. The 737 MAX crashes in 2018, 2019, horrific tragedies. But then, followed by the 2024 quality failures, the Alaska Airlines panel blowout, loose bolts found.
Yeah, those were shocking headlines.
They shattered public trust. And trust from airlines and regulators, too. A century's worth of reputation for safety and engineering, squandered in just a few years.
It's hard to fathom how it got to this point. How does a duopoly player let this happen internally?
Because the duopoly moat assumes rational, competent players. Boeing's actions have called that into question. The foundation was engineering integrity and regulatory trust. Both are compromised.
And the FAA stepping in to cap production?
That's the direct consequence. An external constraint imposed because of internal failures. The FAA is literally limiting how many planes they can build. Boeing is systematically dismantling its own defenses. They're eroding the moat themselves.
Which leads perfectly into the scuttlebutt. What are customers and employees saying? What's the view from the ground floor? It sounds like it confirms this internal erosion.
It absolutely does. Talking to, or rather simulating talking to, customers and employees reveals a franchise in deep, deep distress.
Let's start with the airlines. Boeing's direct customers. Are they sticking by them?
Well, they're kind of trapped, aren't they? Because of the duopoly and those long backlogs, they don't have immediate alternatives for many needs. Can't just order 100 planes from someone else tomorrow.
So they have to tolerate it.
Tolerate, yes. But their frustration is palpable. The delays, the quality issues, the groundings, it messes up their schedules, angers their customers. They're dealing with Boeing's fallout directly.
And the flying public. Passengers?
Trust is severely eroded. That 2024 survey you mentioned finding 54% prefer Airbus, 50% uneasy about Boeing's safety, that's telling. And their Net Promoter Score, NPS, reflects it.
What was that score again?
A paltry +7 for Boeing. Airbus is at +27. A +7 NPS isn't just indifference. It means a lot of people are actively unhappy, detractors. In aviation, that's deeply worrying. The public perception is clearly a shift from safety culture to profit focus.
A huge shift. So the customers are unhappy, trapped but unhappy. What about the employees? Does their perspective reveal the root cause?
I think it absolutely does. The view from inside is grim. Remember that FAA expert panel report from early 2024?
Vaguely. What did it find?
It was damning. Found a major disconnect between senior management and the frontline workers. And crucially, it found employees feared retaliation for raising safety concerns.
Feared retaliation for safety issues in aerospace. That's terrifying.
It's the absolute sign of a broken safety culture. And it's backed up by employee accounts. People describing immense pressure to meet deadlines, poor communication, feeling like quality became secondary to schedule.
Didn't you mention a former manager's quote?
Yes. Describing it as one of the worst professional experiences, feeling set up to fail by the push for speed. These aren't just isolated complaints. They paint a picture of systemic problems.
Okay, let's unpack this. So, what does this all mean? This fear, this pressure, this disconnect. Why is this cycle so hard to break?
The overarching narrative is pretty clear and consistent. Boeing's historical engineering-led culture, the pride in building the best, safest planes, it was systematically dismantled, replaced by a finance-driven ethos prioritizing cost cuts and short-term shareholder returns over quality and safety.
And that creates a vicious cycle.
A vicious, self-reinforcing cycle. Disengaged, fearful workers under pressure make mistakes. Mistakes lead to incidents. Incidents destroy trust and bring intense regulatory scrutiny. Scrutiny and financial pressure reinforce the management focus on cost and schedule, perpetuating the toxic culture.
And breaking that cycle.
Exceedingly difficult. It's not just changing a process. It's changing culture, incentives, trust, power dynamics, embedded over decades. It takes years, maybe a decade or more, of consistent leadership focused on long-term health, not just next quarter's numbers. It's a monumental task, and it means any turnaround will be long, hard, and uncertain.
Which brings us squarely to priority 2. Management, stewardship, and financial resilience, because this sounds like it all comes back to leadership philosophy over many years.
It absolutely does. The decline is directly tied to leadership choices, especially around capital allocation and incentives.
Let's talk about the pre-crisis Muhlenberg era. The focus then was heavily on shareholder returns, right?
Overwhelmingly so. It wasn't subtle. Between 1998 and 2018, Boeing spent, get this, $61 billion on stock buybacks.
$61 billion. How much was that relative to profits?
That was 82% of their cumulative profits over those 2 decades. And if you add dividends, total cash return to shareholders was 121% of net income. They returned more than they earned.
Wow. Literally prioritizing payouts over keeping cash in the business.
And it was incentivized. From 2014, executive pay was significantly tied to total shareholder return, TSR. So management was directly rewarded for boosting the short-term stock price, often via buybacks.
And the argument is this focus led to the 737 MX decision, re-engining an old plane instead of designing a new one.
That's the critical argument, yes. Re-engining was cheaper and faster in the short term, avoided the massive cost of a clean sheet design. But it led to the MCS system, the crashes, a catastrophic miscalculation costing tens of billions, destroying lives and reputation, a clear trade-off. Short-term financial gain for long-term industrial health.
Okay, so that was then. Now we're in the Calhoun era, crisis management. The tone is different, right? Renewed focus on safety, quality.
The public rhetoric, yes. CEO Dave Calhoun has emphasized safety, transparency, called the Alaska Airlines incident a watershed moment, talked about needing a fundamental cultural shift.
But there's skepticism.
Considerable skepticism. Because, look, as late as 2022, after the MAX crashes, Calhoun's plan still targeted $10 billion in annual free cash flow by 2026 and resuming shareholder returns. That sounds, well, familiar, doesn't it? Like the old mindset wasn't quite gone.
Still chasing the financial targets, even mid-crisis.
It suggests the urgency for financial results persisted. And now, Calhoun is stepping down by end of 2024. Another leadership change at a critical time. More uncertainty when they need stability most.
So let's look at the capital allocation track record overall. What did the numbers say about priorities?
The numbers are stark. Pre-crisis, say 2013 to 2018, total shareholder returns buybacks plus dividends were $10.46 billion. Total reinvestment, R&D plus capital expenditures was only $5.84 billion.
Nearly twice as much going out to shareholders as going back into the business itself.
Textbook value extraction.
Yeah.
Prioritizing financial engineering over aeronautical engineering, you could say.
What about the recent move to buy Spirit Aerosystems for $8.3 billion? Isn't that a big reinvestment?
It is big, yes, but it's an exception born of necessity, not proactive strategy. Remember, Spirit was spun off from Boeing in 2005 to cut costs by outsourcing.
Right. They made the 737 fuselages.
Exactly. And that outsourcing, that fragmentation, contributed to quality issues. So buying Spirit back now is a costly attempt to regain control over core production they shouldn't have outsourced. It's a tacit, multi-billion-dollar admission that the previous outsourcing strategy failed. They're fixing a past mistake under duress.
So applying that rationality test, what's the verdict on management stewardship based on this capital allocation history?
The verdict is pretty clear. Pre-crisis management was driven by short-term financial metrics, primarily TSR, not long-term industrial health, spending almost double on shareholder returns versus reinvestment in the years leading up to the crisis. It was profoundly irrational in hindsight. It hollowed out the company, leading directly to the permanent impairment we see now.
Permanent impairment. That brings us to the financial fortress, or lack thereof. A wonderful company needs resilience. Boeing sounds like the opposite right now, like a ruin.
It's an apt description. Financially, Boeing is the antithesis of a reliable earnings machine, consistently deeply unprofitable from 2019 through 2024. Billions in net losses year after year.
And you mentioned they didn't even make a gross profit recently.
In FY24, yes. Cost of products sold exceeded revenue. The direct costs of making things were higher than the money they brought in from selling them. That's a stunning failure for a manufacturer of this scale. Fundamentally broken economics at the core.
Let's hit those key ratios. Return on invested capital, ROIC. How does that look?
Collapsed. Used to be very high pre-2019, showing their old strength. Now, deeply negative. It hit -19.0% in the last fiscal year. That means they are actively destroying capital. Every dollar invested is, on average, losing value for the company.
Destroying capital. Not good. What about free cash flow? Are they generating cash?
Hemorrhaging it. FCF has been wildly volatile and mostly massively negative for 5 years. FY 2024 saw a cash burn of $14.3 billion. They're not generating cash to pay debt, invest, or return to owners. They're burning through it. Huge red flag.
And the balance sheet. After all these losses and cash burn.
Ravaged. End of Q3 2023 numbers showed $52.3 billion in debt versus only $16 billion in cash. Yes, they have credit lines, but that's a precarious debt load for a cash-burning business. And critically, negative book value. Liabilities exceed assets, shareholder equity wiped out on paper, limits flexibility dramatically.
So if these terrible financial metrics are the symptom, not the disease, what's the key takeaway?
The takeaway is that these numbers reflect the deep cultural and operational failures. The production mess stops cash coming in, while rework, compensation, compliance costs destroy profits. The financials will only get better after the underlying cultural disease is cured. And curing that takes years, not quarters. It's a fundamental repair job.
Okay. Priority 3, price versus value and the future outlook. Given everything, how on earth do you value Boeing today?
It's incredibly difficult. Traditional metrics are basically useless. Price to earnings? Negative. Price to free cash flow? Negative and meaningless. You can't use them for comparisons or anchors.
And compared to the past?
Night and day. Pre-crisis, PE was maybe 15-25x. PFCF was 10-15x in the good years. Healthy multiples reflecting a strong business. Those benchmarks are irrelevant now.
So the crucial judgment on the current price is?
It's a demanding and highly speculative entry point. You're absolutely not buying a wonderful company at a fair price here. You're making a high-risk bet on a complex, multi-year turnaround, succeeding flawlessly against huge headwinds.
So it's like buying a call option on a transformation.
Exactly. A call option with an unknown expiry date and a highly uncertain probability of success. Rational, value-based assessment is almost impossible right now.
But there's that growth engine, right? The underlying demand that must count for something.
It's the single most powerful force in their favor. That undeniable secular growth in air travel, the world needing 44,000 new planes, that creates the backdrop against which they could recover.
And the backlog. The 5,600 planes.
It's a massive source of potential future revenue. If they can stabilize production, build safely, build efficiently, that backlog is a lifeline, but only if they can actually grab it.
Okay, demand is there, backlog is there, but what about those permanent impairment risks? Could the damage be irreversible, even if they sort out production somewhat?
That's the crux of the long-term risk. Several things could permanently scar their earning power. First, irreparable brand and trust damage. If Boeing becomes permanently linked to unsafe in people's minds.
Airlines might prefer Airbus just for peace of mind, a persistent Airbus premium.
Exactly. Leading to permanent market share loss, lower pricing power, irreversible damage.
And the cultural rot. Can that truly be fixed?
That's the core risk.
Yeah.
If they can't genuinely restore that engineering-first, quality-obsessed culture, if the finance-first ethos remains too embedded, they could be condemned to perpetual production issues, cost overruns, quality escapes.
Becoming like a low-margin utility manufacturer instead of a leader?
Precisely. Constantly fighting internal fires instead of innovating. Permanently lower margins and earnings.
And the regulators. The FAA scrutiny.
That could become permanent. The FAA got burned being too lax before. Now they're under intense pressure to be tough. This intense oversight could structurally limit production, add huge compliance costs, slow down new plane certifications, permanently lowering growth and profitability. The FAA itself talks about 3 to 5 years just to see signs of holistic reform, not a quick fix.
Okay, let's apply some second-level thinking. What's the market consensus on Boeing? What's the common view?
The market narrative generally seems to be fallen angel, a compelling turnaround play. The consensus thinks it's too big, too important to fail, Duopoly is secure. Issues will resolve with time, new leaders. They expect production, cash flow, share price to recover eventually.
Wow.
Secular growth lifts all boats, right?
But our deep dive points to a very different, more contrarian view.
It does. Our analysis suggests the market is fundamentally underestimating the time, cost, and sheer difficulty of fixing a broken corporate culture. It's seeing a production problem solvable with process tweaks.
Whereas our view is,
It's a deep-seated cultural disease, metastasized over decades, due to that philosophical shift from engineering to finance. That takes far longer, maybe a decade plus, to truly cure, if it's even possible.
and what's the key thing the market is missing or underappreciating here? The elephant in the room.
The primary constraint, the FAA. The production cap on the 737 MX isn't just a temporary bottleneck. It's a hard ceiling imposed by the regulator, tied directly to fixing that intangible safety culture. Boeing cannot ramp up significantly until the FAA is satisfied.
And the market might be modeling a faster recovery than the FAA will allow.
Exactly. The market seems to expect a V or U-shaped recovery. The reality, constrained by the FAA's subjective assessment of cultural change, is much more likely to be a long, painful, L-shaped period of stagnation or very slow growth, maybe years.
And what's fascinating here is the implication of that stagnation.
Right. While Boeing is stuck in this L-shape, unable to deliver what's happening, they are forced to continue donating permanent market share to Airbus. An airline frustrated by Boeing shifts to Airbus. That decision is likely locked in for decades due to switching costs.
So temporary production problems cause permanent competitive damage.
Irreversible damage. Our conclusion isn't that Boeing is temporarily impaired, it's that Boeing is potentially being relegated to the permanent role of junior partner in the duopoly, like GM to Toyota in autos, maybe.
Airbus gets the lion's share of the growth, leaving Boeing shareholders with what?
A structurally lower growth, lower margin, permanently smaller business than history suggests. That is the most compelling path to permanent capital impairment, even if they avoid outright collapse. The market might be pricing a recovery to the old Boeing, which may no longer exist.
Okay, let's synthesize. The final investment thesis. The bull case why someone might still invest boils down to a few key things.
Sure, you've got the powerful duopoly, high barriers to entry, undeniable secular growth in air travel providing demand, a huge backlog, offering theoretical revenue if they fix things, and strategic importance, implying some government backstop.
On paper, compelling points. But the bear case, which our deep dive really supports.
That's much stronger, frankly. It centers on that broken culture, prioritizing finance over engineering, the root cause. This leads to an eroding Moat seating share, trust, pricing power to Airbus. Then the financial ruin, unprofitable, burning cash, high debt, negative equity. And finally, the uncertain turnaround, long, risky, dependent on fixing culture under intense, multi-year regulatory scrutiny.
So the core conclusion. Boeing fails the wonderful company test. Its fortress is crumbling from within. Investing now isn't value investing.
It's a speculative wager on a deeply flawed transformation with a highly uncertain outcome.
Which leaves us with a final thought for our listeners.
Yeah, something for you to really consider. Given these profound cultural issues, the regulatory chains,
Yeah.
will Boeing ever truly regain its historical identity as that engineering powerhouse? Or is it destined to be a shadow of its former self, always battling internal demons while the industry flies ahead? What does it mean for a company to lose its soul? And can it ever truly get it back? That's the deep question here.
That's something to definitely mull over. We hope this deep dive gave you valuable context. Revisit the insights, share your thoughts, and please join us for the next one. Until then, stay curious.